A tax haven is a state, country, or territory where, on a national level, certain taxes are levied at a very low rate or not at all. It also refers to countries which have a system of financial secrecy in place. It should be noted that financial secrecy can be used by foreign individuals to circumvent certain taxes, because the requirement of paying taxes on these funds cannot be transmitted, as the funds themselves are invisible to the country the individual is from. Such taxes can be avoided. Earnings from income generated from real estate can also be eliminated this way. Despite this occasional abuse, the countries themselves stand in their right to have a system of financial secrecy in place, and it is up to the individual to fill in the required paperwork. If the proper double taxation forms are filled in, and taxes are paid, companies can avoid much taxes, even if they hence pay their taxes legally. This is because the tax rates on income can be much lower than the tax rate in their own country. It should be noted that some taxes cannot be avoided or reduced, as these are levied by the country the real estate you own is in, and hence need to be paid just the same as any other resident of that country. The only thing that can be done is picking a country that has the smallest rates on these taxes before you buy any real estate. Individuals or corporate entities can find it attractive to establish shell subsidiaries or move themselves to areas with reduced or nil taxation levels relative to typical international taxation. This creates a situation of tax competition among governments. Different jurisdictions tend to be havens for different types of taxes, and for different categories of people or companies. States that are sovereign or self-governing under international law have theoretically unlimited powers to enact tax laws affecting their territories, unless limited by previous international treaties. There are several definitions of tax havens. The Economist has tentatively adopted the description by Jeffrey Colin Powell. What identifies an area as a tax haven is the existence of a composite tax structure established deliberately to take advantage of, and exploit, a worldwide demand for opportunities to engage in tax avoidance. The Economist points out that this definition would still exclude a number of jurisdictions traditionally thought of as tax havens. Similarly, others have suggested that any country which modifies its tax laws to attract foreign capital could be considered a tax haven. According to other definitions, the central feature of a haven is that its laws and other measures can be used to evade or avoid the tax laws or regulations of other jurisdictions. In its December 2008 report on the use of tax havens by American corporations, the U.S. Government Accountability Office was unable to find a satisfactory definition of a tax haven but regarded the following characteristics as indicative of it: nil or nominal taxes, lack of effective exchange of tax information with foreign tax authorities, lack of transparency in the operation of legislative, legal or administrative provisions, no requirement for a substantive local presence, and self-promotion as an offshore financial center. A 2012 report from the Tax Justice Network estimated that between USD $21 trillion and $32 trillion is sheltered from taxes in unreported tax havens worldwide. If such wealth earns 3% annually and such capital gains were taxed at 30%, it would generate between $190 billion and $280 billion in tax revenues, more than any other tax shelter. If such hidden offshore assets are considered, many countries with governments nominally in debt are shown to be net creditor nations. However, despite being widely quoted, the methodology used in the calculations has been questioned, and the tax policy director of the Chartered Institute of Taxation also expressed skepticism over the accuracy of the figures. Another recent study estimated the amount of global offshore wealth at the smaller, but still sizable, figure of $7.6 trillion. This estimate included financial assets only. My method probably delivers a lower bound, in part because it only captures financial wealth and disregards real assets. After all, high-net-worth individuals can stash works of art, jewelry, and gold in free ports, warehouses that serve as repositories for valuables. Geneva, Luxembourg, and Singapore all have them. High-net-worth individuals also own real estate in foreign countries. A study of 60 large U.S. companies found that they deposited $166 billion in offshore accounts during 2012, sheltering over 40% of their profits from U.S. taxes. Definitions. The Organization for Economic Cooperation and Development identifies three key factors in considering whether a jurisdiction is a tax haven: nil or only nominal taxes. Tax havens impose nil or only nominal taxes and offer themselves, or are perceived to offer themselves, as a place to be used by non-residents to escape high taxes in their country of residence. Protection of personal financial information. Tax havens typically have laws or administrative practices under which businesses and individuals can benefit from strict rules and other protections against scrutiny by foreign tax authorities. This prevents the transmittance of information about taxpayers who are benefiting from the low tax jurisdiction. Lack of transparency. A lack of transparency in the operation of the legislative, legal or administrative provisions is another factor used to identify tax havens. The OECD is concerned that laws should be applied openly and consistently, and that information needed by foreign tax authorities to determine a taxpayer's situation is available. Lack of transparency in one country can make it difficult, if not impossible, for other tax authorities to apply their laws effectively. Limited regulatory supervision or a government's lack of legal access to financial records are contributing factors. However, the OECD found that its definition caught certain aspects of its members' tax systems. Its later work has therefore focused on the single aspect of information exchange. This is generally thought to be an inadequate definition of a tax haven, but is politically expedient, because it includes the small tax havens but exempts the powerful countries with tax haven aspects such as the USA and UK. In deciding whether or not a jurisdiction is a tax haven, the first factor to look at is whether there are no or nominal taxes. If this is the case, the other two factors, whether or not there is an exchange of information and transparency, must be analyzed. Having no or nominal taxes is not sufficient, by itself, to characterize a jurisdiction as a tax haven. The OECD recognizes that every jurisdiction has a right to determine whether to impose direct taxes and, if so, to determine the appropriate tax rate. Classification. Corporations, in order to achieve effective tax avoidance, use multiple types of tax havens. Three types of tax haven types form a Dutch sandwich. Primary tax havens, the location where financial capital winds up. Subsidiary shell companies, they have obtained rights to collect profits from corporate intellectual property by transfers from their parent. Semi-tax havens, locations that produce goods for sale primarily outside of their territorial boundaries and have flexible regulations to encourage job growth, such as free trade zones, territorial-only taxation, and similar inducements. Conduit tax havens, locations where income from sales, primarily made outside their boundaries, is collected, and then distributed. Semi-tax havens are reimbursed for actual product costs, perhaps with a commodity markup. The remaining profits are transferred to the primary tax haven, because it holds rights to profits due to the corporate IP. By matching outflow to income, they do not retain capital, and their role, while crucial, remains invisible. Large multinational corporations may have dozens of such tax haven entities interacting with each other. Each haven can claim that it does not satisfy definitions that attempt to place all tax havens into a single class. Even increased transparency does not change the effectiveness of corporate tax avoidance. Extent. Capital held offshore while incomplete, and with the limitations discussed below. The available statistics nonetheless indicate that offshore banking is a very sizable activity. The OECD estimated in 2007 that capital held offshore amounted to between $5 trillion and $7 trillion, making up approximately 6 to 8% of total global investments under management. A more recent study by Gabriel Zuman of the London School of Economics estimated the amount of global cross-border wealth held in tax havens at $7.6 trillion. Of which $2.46 trillion was held in Switzerland alone. The Tax Justice Network estimated in 2012 that capital held offshore amounted to between $21 trillion and $32 trillion, although those estimates have been challenged. In 2000, the International Monetary Fund calculated based on Bank for International Settlements data that for selected offshore financial centers, on-balance sheet cross-border assets held in offshore financial centers reached a level of $4.6 trillion at the end of June 1999. Of that $4.6 trillion, $0.9 trillion was held in the Caribbean, $1 trillion in Asia, and most of the remaining $2.7 trillion accounted for by the major international finance centers, namely London, the US, IBFs, and the Japanese offshore market. The U.S. Department of Treasury estimated that in 2011 the Caribbean banking centers, which include Bahamas, Bermuda, Cayman Islands, Netherlands, Antilles and Panama, held almost $2 trillion in United States debt. Of this, approximately $1.4 trillion is estimated to be held in the Cayman Islands alone. The Wall Street Journal, in a study of 60 large U.S. companies, found that they deposited $166 billion in offshore accounts in 2012, sheltering over 40% of their profits from U.S. taxes. Similarly, Desai, Foley and Hines in the Journal of Public Economics found that, in 1999, 59% of U.S. firms with significant foreign operations had affiliates in tax haven countries, although they did not define significant for this purpose. In 2009, the Government Accountability Office reported that 83 of the 100 largest U.S. publicly traded corporations and 63 of the 100 largest contractors for the U.S. federal government were maintaining subsidiaries in countries generally considered havens for avoiding taxes. The GAO did not review the company's transactions to independently verify that the subsidiaries helped the companies reduce their tax burden, but said only that historically the purpose of such subsidiaries is to cut tax costs. James Henry, former chief economist at consultants McKinsey & Company, in his report for the Tax Justice Network, gives an indication of the amount of money that is sheltered by wealthy individuals in tax havens. The report estimated conservatively that a fortune of $21 trillion is stashed away in offshore accounts, with $9.8 trillion alone by the top tier, less than 100,000 people, who each own financial assets of $30 million or more. The report's author indicated that this hidden money results in a huge lost tax revenue, a black hole in the economy, and many countries would become creditors instead of being debtors if the money of their tax evaders would be taxed. Lost tax revenue. The Tax Justice Network estimated that global tax revenue lost in 2012 to tax havens is between USD $190 billion and $255 billion per year, assuming a 3% capital gains rate, a 30% capital gains tax rate, and $21 trillion to $32 trillion hidden in tax havens worldwide. The Zoom-on study uses different methodology, and estimates lost global tax revenue at $190 billion. If such hidden offshore assets are considered, many countries with governments nominally in debt are shown to be net creditor nations. However, the tax policy director of the Chartered Institute of Taxation expressed skepticism over the accuracy of the figures. If true, those sums would amount to approximately 5 to 8 times the total amount of currency presently in circulation in the world. Daniel J. Mitchell of the Cato Institute says that the report also assumes, when considering notional lost tax revenue, that 100% money deposited offshore is evading payment of tax. In October 2009, research commissioned from Deloitte for the Foot Review of British offshore financial centres said that much less tax had been lost to tax havens than previously had been thought. The report indicated, "We estimate the total UK corporation tax potentially lost to avoidance activities to be up to £2 billion per annum, although it could be much lower." An earlier report by the UK Trades Union Congress concluded that tax avoidance by the 50 largest companies in the FTSE 100 was depriving the UK Treasury of approximately £11.8 billion. The report also stressed that British Crown dependencies make a significant contribution to the liquidity of the UK market. In the second quarter of 2009, they provided net funds to banks in the UK totaling $323 billion, of which $218 billion came from Jersey, $74 billion from Guernsey and $40 billion from the Isle of Man. The Tax Justice Network reports that this system is basically designed and operated by a group of highly paid specialists from the world's largest private banks, law offices, and accounting firms, and tolerated by international organizations such as Bank for International Settlements, the International Monetary Fund, the World Bank, the OECD, and the G20. The amount of money hidden away has significantly increased since 2005, sharpening the divide between the super-rich and the rest of the world. Examples: the U.S. National Bureau of Economic Research has suggested that roughly 15% of the countries in the world are tax havens, that these countries tend to be small and affluent, and that better governed and regulated countries are more likely to become tax havens, and are more likely to be successful if they become tax havens. Switzerland, Luxembourg, primarily a conduit tax haven. Other sovereign countries that have such low tax rates and LAX regulation that they can be considered semi-tax havens are Ireland, Netherlands, primarily a conduit tax haven. Non-sovereign jurisdictions commonly labeled as tax havens include Jersey, Isle of Man, British Overseas Territory, Bermuda, British Virgin Islands, Cayman Islands, Delaware, United States, Puerto Rico. Some tax havens, including some of the ones listed above, do charge income tax as well as other taxes such as capital gains tax, inheritance tax, and so forth. Criteria distinguishing a taxpayer from a non-taxpayer can include citizenship and residency and source of income. For example, in the United States, foreign non-residents are not charged various taxes including income tax on interest on U.S. bank deposits by income tax. Since the Clinton administration, the IRS has proposed collecting information on these depositors to share with their home countries as a regulation. These regulations were eventually finalized in April 2012. In September 2013, British Prime Minister David Cameron said, "I do not think it is fair any longer to refer to any of the overseas territories or Crown dependencies as tax havens. They have taken action to make sure that they have fair and open tax systems. It is very important that our focus should now shift to those territories and countries that really are tax havens." Mr. Cameron's comments were interpreted as a direct reference to Jersey, Guernsey, Isle of Man, the British Virgin Islands and the Cayman Islands, and followed a period of negotiations with those British territories during which those jurisdictions had made a number of concessions relating to tax transparency and sharing of information. Anti-tax haven pressure groups immediately accused the Prime Minister of taking leave of his senses, and commenting sarcastically, "It was Cameron's father's tax haven activities that are reported, sick to have paid for his Eton education." Was it never realistic to think he'd change his spots? Former tax havens. Beirut, Lebanon, formerly had a reputation as the only tax haven in the Middle East. However, this changed after the intra-bank crash of 1966, and the subsequent political and military deterioration of Lebanon dissuaded foreign use of the country as a tax haven. Liberia had a prosperous ship registration industry. The series of violent and bloody civil wars in the 1990s and early 2000s severely damaged confidence in the jurisdiction. The fact that the ship registration business still continues is partly a testament to its early success, and partly a testament to moving the National Shipping Registry to New York, United States. Tangier had a brief but colorful existence as a tax haven in the period between the end of effective control by the Spanish in 1945 until it was formally reunited with Morocco in 1956. A number of Pacific-based tax havens have reduced their effectiveness to operate as tax havens in response to OECD demands for better regulation and transparency in the late 1990s. Vanuatu's Financial Services Commissioner announced in May 2008 that his country would reform its laws so as to cease being a tax haven. We've been associated with this stigma for a long time and we now aim to get away from being a tax haven. As of March 2013, update. Major Cyprus banks have sustained severe damage from Greek bond defaults and closed their doors in an attempt to stem a flight of capital from the island. Depositors are expected to incur heavy losses.